Hello, good morning. It's Wednesday the 6th. I'm FX Blue, ducked out in a break in the rain to bring you the market brief. So, UK inflation, that's still pretty rampant, and the market expects the Bank of England to continue increasing interest rates to bring it under control. Many at the bank believe that inflation has not yet crossed over to wage demands, but wider market sentiment suggests it's only a matter of time before wage demands begin to rise. That is, of course, despite all those bigwigs at the Bank of England on those strong six-figure publicly funded salaries asking for the public to show restraint by not asking for pay rises. But will interest rates reach 2% this year? If the economy does start to slow this month, then perhaps rates won't go much above 1.5% for fear of causing a recession. But pausing there will likely see inflation remain uncomfortably high well into next year. So the choice of recession or high inflation, it's a pretty unsavoury outlook. So perhaps that's when we'll start to see them earn those strong six-figure salaries. You never know. In the market yesterday, sterling fell to 130.75 against the dollar, and that's where we opened this morning. But we are back up to the 120 level against the euro. Bravo indeed. Over in the US, market expectation is for the Fed to raise interest rates by 50 basis points at their next meeting. That's on May the 4th. May the 4th be with you, of course, but also to start reducing their balance sheet. The view is that tighter monetary policy, including both rate hikes and a reduction in the balance sheet, should help return policy to a more neutral level. The US trade deficit slipped a little in February. It remained close to the record highs. However, also bear in mind that the war in Ukraine broke out since then, so the data is fairly irrelevant. However, following all the sanctions put in place against Russia, the US is looking at even closer links with Canada. And one rather obvious benefit to this is that Canada has the third largest oil reserves in the world. They have about 10% of the world's reserves, which is more than double Russia. Yaboo sucks to Russia, hey? Meanwhile, in the market, the dollar index benefited from a fall in risk appetite and, of course, some more hawkish comments from Fed officials. We saw the index rise to 99.45 yesterday, which is the highest level we've seen all year. Further gains were perhaps held back ahead of the Fed minutes today, but nevertheless it helped drive euro dollar down below the 109 level. We opened this morning around 108.80. That's it from me. Join me again tomorrow.
If you do not have a clue, then just tweet through and ask FX Blue.